Welcome back to Run the Numbers in my half-done studio. That's why I'm sitting in the dark. We haven't done all the lights yet. Also, I don't know how to work any of this stuff. It's funny. I'm building this studio out, but I'm like the least technologically savvy person out there. I'm using dial-up internet right now. I'm on a beep, bop, bop. Remember that when you used to connect to MySpace back in the day? But do you ever like struggle to do normal person stuff? I live in a world where I go on the computer and write newsletters and open Excel workbooks and smash the keys to make numbers. But like I can't do normal person stuff in real life. So my wife is like, my tires on my car, they're low. I'm like, oh, I'll be a big hulking man and sort this out for you. I take it to the gas station and the tire pressure in the front's at like 28. And I press the PSI button on the machine and it changes it instead to 22. I'm like, huh, that's funny. Basically, I end up leaving the gas station with all four tires at a lower pressure than when I went. So that was rather embarrassing. Something I do know a little bit about, though, is capital allocation. So I may not be able to fill the tires on a car. I also didn't know that my house used natural gas. My father-in-law came over the other day. I'm on a tangent now. And he's like, CJ, it smells like gas outside in the backyard. I'm like, gas? Why would there be gas? Did I leave the grill on? And he's like, no, 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 no. Like the gas line from the house. I think there's a leak. You should probably call the natural gas station. But of course, my wife pays for that. It's on a credit card somewhere. And I didn't even know that it was a gas house. But once again, I'm an idiot. Back to capital allocation, right? After a short word from our sponsors who know a thing or two about ERPs and AI. Take it away, Campfire. If you've ever lived through an ERP migration, you probably have the scars to prove it. Those migrations are horrible and they have endless consulting fees. And even after you're live, getting simple answers still means hours in spreadsheets. I can't tell you how many times I've exported from an ERP to a spreadsheet just to figure out what I should have been able to figure out in the ERP itself and do my own back of the envelope math. But Campfire fixes that. It's the AI first ERP built for modern finance and accounting teams. It's helping mid-market and enterprise teams close faster, unlock insights instantly, and scale smarter without the additional headcount. And I know this because I actually use Campfire myself. It's what we run mostly media on, and it's been a game changer for our finance workflow. The interface is intuitive, migration was quick and painless. Seriously, their team is incredible, and it's freed us up to focus on actually making media. And they just raised $35 million from a sell to further reimagine the ERP, one of the best investors in the game. And that's not an easy undertaking, right? These guys are doing something very bold. I'm so excited to see how they keep reimagining the space, and you should be too. Check them out at www.campfire.ai. That's www.campfire.ai and get on the same ERP that your boy's on. So Warren Buffett has this amazing quote. It is almost impossible to overpay the truly extraordinary CEO. And so if you distill it down, every CEO has three jobs: to run a good company, which you call operations, to tell a good story, which is investor relations, and to deploy capital effectively, which is capital allocation. And so most CEOs focus 80% or more of their time on the first two, running a good company and telling a good story. But it's the third, capital allocation, often has the highest leverage yet the least guidance. We don't teach anybody about capital allocation in school. And the business world is traditionally separated into like this binary world of operators and investors. It's like you either are the one who's providing capital or the one receiving it. But in a private equity backed context in particular, the CEO, they straddle both roles. In fact, I would argue that it's an even more concentrated investment under stricter timelines. And so why do I say that? The institutional investor, they might diversify across dozens of assets. And a CEO, they only have one asset in their portfolio. It's the business that they're running day to day. And what's more, the private equity backed CEO, they're held to an even shorter timeline, typically 3 to 5 years, compared to institutional investors who can ride out cycles. You're seeing that with all these continuation vehicles springing up. If like 8 to 10 years for a fund wasn't enough, they can extend it and sell chunks of themselves to another fund they own or to another GP. And so if it's not apparent yet, capital allocation is a required skill set at the top. But CEOs are not given the experience to be great capital allocators before they get to the seat, which is weird. They climb the ranks by being like awesome at one subject area. They could be like a CRO or a CPO, and they're really, really good at their domain. But when they get to the CEO role, they're expected to shape the future of the company by strategically placing chips on the table. And that's when they enter this realm of investor. And Buffett put it really well. He said, the heads of most companies are not skilled in capital allocation. Their inadequacy is not surprising. Most bosses rise to the top because they've excelled in an area such as marketing, production, engineering, or administration. It's as if the final step for a highly talented musician was not to perform at Carnegie Hall, but instead to be named chairman of the Federal Reserve. And so let's talk about the toolkit, because capital allocation isn't just about spending more or less money. That's not what it is. Like, did we come in over or under budget? That's not it. It's about the return on invested capital, which investors called ROIC. Rock, pass the rock. ROIC. And I'm going to name my first son Roik, and how intelligently you compound shareholder value. And so I've been obsessed with this book recently. It's William Thorndike's The Outsiders, which defines capital allocation as the process of deciding how to deploy the firm's resources to earn the best possible return for shareholders. So you have 5 basic deployment levers. 1, invest in the core business. 2, acquire other businesses. 3, issue dividends. 4, pay down debt. And 5, repurchase shares. And there are 3 ways to raise capital to do that. You can do it through internal cash flow, through debt, and through equity. And this is your capital allocator's toolkit. And what Thorndike says in his book is, stated simply, 2 companies with identical operating results and different approaches to allocating capital will derive 2 very different long-term outcomes for shareholders. So I want to walk through 2 of those levers from the private equity operator's perspective. So let's get into private equity capital allocation and practice. So from the perspective of someone running a PE-backed company, investing in the core business and acquiring other companies are the most practical, most common capital allocation tools. These are the moves that drive top-line growth, expand margins, and justify valuation uplifts during a 3 to 5 year hold period. Like, yes, servicing debt is always top of mind, but paying down principal is typically deferred until you're closer to an exit. So why is that? Because keeping leverage in place, that was the point, right? It allows you to amplify equity returns without diluting your cap table. And as long as covenants are under control, the financial model favors debt-fueled growth. Dividends have long been considered an inefficient way to return capital. And this was surprising to me from the book. I never thought about it this way, because they're taxed once at the company level as profits, and then they're taxed again at the individual shareholder level when you receive the dividend. And in the private equity world, dividends do have a specific purpose. They give sponsors a way to extract cash earlier, especially during periods when exit conditions aren't favorable. They're used strategically in a way to realize value without actually having to sell off the asset. And then share purchases, just to put this one to the side, meanwhile, are largely irrelevant for private companies. These only become relevant when nearing a public exit. And even then, only as a method of capital structure optimization or return enhancement. So for private equity operators, let's park that. It's a non-factor. So let's explore the first 2. So the clearest blueprint of how to allocate capital with operational discipline comes from a very surprising place: broadcast media. Capital Cities was a scrappy media company that ultimately acquired ABC and later sold to Disney for a record $19 billion in 1995 for a media company. And this was a masterclass in both operational excellence and capital deployment for about 30 years. So under the leadership of this guy, CEO Tom Murphy, and his COO, his right hand, Dan Burke, Capital Cities ran what we would now call a disciplined, high ROI roll-up strategy. Murphy owned capital allocation, acquisitions, and strategy as a CEO, and Burke ran the day-to-day business and drove operational excellence. And their mantra was, Burke creates the cash and Murphy allocates it. Let's talk about investing in the core business. Cap Cities believed that capital allocation, cap and cap, cap squared, began with human capital. They hired smart, high upside operators, even those without direct industry experience. It's actually how Murphy got into it. He had never worked in media before. He was like sent to go and work on this like upstate New York radio station coming from investment banking. And so what they would do is they would give them wide autonomy to run local markets, and the corporate HQ was intentionally lean. Decision making was pushed to the field. It was extremely decentralized. And their ethos was like, hire the best people and then just leave them alone. Underrated hack, everyone. And this extreme decentralization wasn't just about culture, it was about a capital allocation strategy. So Murphy and Burke believed that local market leadership created margin dominance, especially in local news, which in turn drove outsized ad revenue. And in that sense, the company was careful, not cheap. They were willing to spend on talent and they were willing to spend on the right things that would allow them to get to that number one market position in any geographical area because they knew that there would be outsized returns for the winners. Kind of like the Uber versus Lyft debate. I think Uber has more than a 10x higher market cap than Lyft right now, the number two player in the US. And so Cap Cities was ruthless about unit economics, and they didn't chase scale for its own sake. They shut down or sold underperforming divisions, and they prioritized long-term value creation over short-term optics. And as Murphy said, the goal is not to have the longest train, but to arrive at the station first using the least fuel. And they did that through the young stars. This is a pretty amazing coaching tree. They had Bob Iger, the future CEO of Disney, and then they also had the CEOs of Hearst, Pulitzer, and NBC Universal come up through their ranks. Let's talk about acquiring other businesses because the discipline they had created conviction. The discipline in their operating model, that is. Murphy's strength as a capital allocator was grounded in operating leverage. I love that term. He didn't make acquisitions just hoping that they'd become more profitable. He had confidence they would be because Burke's team had a repeatable integration model. This gave him what every private equity operator wants: conviction in doing a deal. And Murphy would say, I get paid not to make deals, but to make good deals. Knowing that they had a bullpen of young, hungry, talented execs, which you touched upon, who were ready to step up with the operational rigor to execute, the acquired units would be made more profitable, lowering the effective price paid. So to say that again, they would bid an amount, but they would know that within 6 months, a year, 2 years, they will have paid a cheaper price for that asset because of the operational excellence they have. So Cap Cities, they only pursued acquisitions that met strict return hurdles, which was double-digit after-tax returns over 10 years without leverage. And they would usually just model this out quickly, like within an hour in a room. It's not like they would deploy 50 analysts to figure this out. The CEO and COO would have their fingers on the keyboards, or I don't know, pencils back then, to figure out if it met these strict return guardrails. And they used leverage intelligently and paid it down typically within 3 years so they could re-up and buy something else. And they integrated fast and efficiently, boosting margin and cash flow post-close. They weren't playing financial engineering games here. They were running an operating system that worked. They knew it worked, and they scaled it through smart capital deployment. They said, we just kept opportunistically buying assets, intelligently leveraging the company, improving operations, and then we take a bite of something else. Nom, 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 nom. So Murphy and Burke's unique blend of operating and capital allocation skills created what one investor called a perpetual motion machine for returns. That's a beautiful packet of words, a perpetual motion machine for returns. It was a combo of effectively allocating capital to hire the best people and sometimes paying up for top media talent, paid with their selective acquisitions that resulted in a remarkable 19.9% IRR over 29 years. I'll say that again. They returned every year on average 20% for almost 30 years. And this outpaced the 10% return of the S&P 500 at the time comparatively, and the 13% return for an index of the other leading media companies over the same time period. While we broke out the 5 unique types of capital allocation, the best approach is to stack more than one together like Cap Cities did. It goes without saying, but you won't have much capital to allocate, right, if you don't have efficient operations. And you can make much larger and more informed bets when you know acquiring a company is de-risked and actually an arbitrage opportunity in disguise. So given that capital allocation isn't taught in business school, CEOs should make the effort to look at how other greats at other companies from history have applied this lesson, because there are a lot of ways to spend money, but at the end of the day, it all shows up in one metric, and that is your return on invested capital. So if you like this story, by the way, check out lookingforleverage.com. That is our newsletter that goes out once a week. It's free to some of the best private equity backed CEOs and CFOs in the world. So thanks for hanging with us today, and check out Campfire if you're looking for a ERP that is built with AI from the bottoms up. Holler.